Let's analyze this chart. This is GBPUSD on the 15-minute time frame, and I want to show you something that changed the way I trade forever. Stay with me, this will make everything click. Before we start, make sure you subscribe to the channel. I post clean breakdowns like this to help you understand how price actually moves. Now let's get into it. First, price is clearly moving down. It keeps making lower highs and lower lows. That simply means sellers are in control. When price keeps breaking previous lows, we call that a break of structure. It confirms the market is bearish. Now here is where most traders get trapped. After falling for a while, price suddenly shoots up. Strong green candles, big momentum, it looks powerful. And beginners think, okay, the trend is changing, let me buy. But slow down. The market was already bearish. Why would big institutions suddenly decide to buy aggressively in the middle of nowhere? They wouldn't. This move up has a purpose. It is not a reversal. It is a trap. In trading, we call this inducement. Inducement simply means the market creates a move to attract traders in the wrong direction. Price goes up to make buyers confident. It creates excitement. It looks like a breakout. But the real goal is different. Look at this red zone above. That is called an order block. Let me explain simply. An order block is an area where big institutions previously placed large orders. It is a supply zone. They are interested in selling again there. So price moves up, not to continue, but to return to that order block. It is like the market saying, wait, let me go back and finish some business. When price finally reaches that order block, I enter sell immediately. Why? Because everything already made sense. The trend was bearish, liquidity was built, price created a trap move, and now it reached a strong supply zone. That is enough logic. My stop loss goes above the order block. Price breaks above strongly, then my setup will be invalid. Now where's the target? Look below the chart. You see those equal lows? Those lows contain stop losses from people who bought during the bullish move. That is called sell-side liquidity. Big institutions need liquidity to close their sell positions, so price drops aggressively to grab those stops. And notice how fast it falls once it rejects the order block. No hesitation, no confusion, just clean movement. Because the real objective was always below. And once price reaches those lows, it slows down. Why? Because the job is done. Liquidity taken, move completed. This is what most beginners don't understand. Price does not move randomly. It moves from liquidity to liquidity. It goes where orders are resting. If you remember one thing from this video, remember this. The market often moves opposite to what looks obvious. When everyone feels confident buying, be careful. When everyone feels comfortable selling, be patient. Stop chasing strong candles. Start asking, where are the stop losses? Because that is where price is going next. Trading becomes simple when you stop reacting emotionally. Wait for price to reach important zones. Think logically, manage risk, and let the market do the rest. That is how you trade smart. And if you want daily setups, live trade ideas, and more SMC education, join my private Telegram community. The link is in the description. Thanks for watching. Don't forget to subscribe and hit the notification bell so you don't miss the next video.